But I would like for us to start looking more at the Fed's balance sheet. That is where they are controlling different assets throughout the economy with all these different programs that they have and putting money in mortgage-backed securities and agency debt and treasury securities. I mean, that is really where the manipulation happens and the distortion throughout the rest of the economy. Hello, welcome to this week's economy. I'm your host, Dr. Vance Ginn. Thank you for joining me again today. It's a pleasure to have you with me. We got a lot to talk about, lots going on. So let's just jump right into it, all right? Ultimately, what we've seen right now, just to kind of give you an overview, is that the Trump administration has inherited a broken financial policy landscape. President Biden's legacy of regulatory overreach and heavy-handed intervention stifled growth, distorted markets, and limited opportunity for individuals and businesses. What's the good news? The Trump White House and a Republican-led Congress are looking at ways to improve this. And I'm hopeful that there are some good ways to do that because there's a lot of things that need to be improved when it comes to the financial sector. And that's really what I want to get into today. So how did we get here? The background on this is that we have a lot of economic disruptions that have taken place over the last couple of decades. We had financial and monetary policy actions and a whole bunch of other things. Remember the Dodd-Frank Act of 2008? Well, although it was intended to stabilize the financial system after the Great Financial Crisis or Global Financial Crisis, whatever you want to call it, Great Recession is what some have called it. What it really ended up doing, the Dodd-Frank Act that is it reinforced the notion of quote unquote too big to fail. It burdened small banks and it stifled competition. The Federal Reserve's pandemic-era balance sheet expanded, created uncertainty, and raised concerns about its growing economic role. In fact, it became even larger. We saw it shoot up from about $800 billion on their balance sheet to over $4 trillion. Massive increase during that time with all these new sort of funds that they were using and everything else. And it also increased the share of GDP. At that time, the Federal Reserve's balance sheet was about 6% of GDP before 2008 and all their different policy proposals that they put out there. But then it shot up. And even during the pandemic, it went up to closer to 25, 26% of GDP. So the balance sheet has been a major problem. The Biden administration's regulatory overreach, slow growth, and distorted markets, and really it led to more central planning by the Federal Reserve and by the CFPB and by a lot of other SEC and all these other groups that are out there. We can go through a whole bunch of acronyms here, the alphabet soup of acronyms. But in general, what happened is that we've had an overregulated banking sector. What does that do? Well, it creates a situation that makes it you have higher costs of banking. I mean, we have higher fees. We've got a lot of other things that have slowed down innovation. And unfortunately, that's set us up for not success, but failure. Today, the Trump administration and this Republican-led Congress have a crucial opportunity to reverse these damages and policies and unlock America's full economic potential. Because ultimately, right, is that we do need the banking sector. We do need credit access. We need all these things to a certain extent. We've got to make sure we have personal responsibility and good sound policy in there as well. So what do we need for the future? America's financial system performs best when markets are free, incentives are aligned, and individuals are empowered to succeed. That's what happens with free market capitalism. To restore long-term prosperity, Washington must embrace these principles and reject the interventionist agenda of the past. And even by some from across the political spectrum, whether you think about the NatCons or populist or new right, whatever you want to call on the right side, and of course progressives always want to go after banks and everything else. We really need to take a step back and think about where are we. So, number one, we need to roll back Biden-era rules. What I've been looking at here is that the Biden administration pursued a pattern of fiscal irresponsibilities, including costly handouts such as student loan forgiveness and expanded Social Security benefits for many government employees. These actions worsened the national debt, created moral hazards, and unfairly favored select groups at the expense of taxpayers. Meanwhile, the Consumer Financial Protection Bureau, the CFPB, imposed heavy-handed regulations on banks and industries under the guise of consumer protection. We also saw the SEC and others come in and put in their ESG, environmental, social governance sort of agenda, which contributed to less economic activity than otherwise. And now a lot of that's being rolled back as people said, you know what, this isn't a good fiduciary duty of investors, of banks and everyone else. And they're getting out of that business and they shouldn't have never got into it. That's why we see a lot of problems in Europe and other places as well. So what I think we really need to have going on here is that the greatest threat to the financial system is the federal government's top bank regulators left the vault wide open. The Office of the Comptroller of the Currency, part of the U.S. Department of the Treasury, suffered a massive data breach that lasted nearly 2 years. It started during the Biden administration, and it's continued for a while. The scandal highlights a stark double standard. Regulators demand perfection and security from the private sector while failing to uphold basic standards themselves. Imagine that. We also have many damaging policies stem from the CFPB, from excluding medical debt from credit scores to the overdraft rule in Section 1033. The agency disguised expanded federal control as consumer protection. Just ridiculous, right? These rules undermine credit score reliability, risk consumer privacy, and limited access to credit for those who need it most. What should we do instead? We must eliminate reversed harmful regulations, especially those from Dodd-Frank, which should be repealed, and tailor rules based on an institution's size and risk. Repealing restrictions such as the Volcker rule can enhance liquidity and investment opportunities without compromising financial stability. Most importantly, it's time to eliminate the CFPB and end its partisan targeting of disfavored industries and individuals. Catch up on the news of all this from the OCC breach in my latest For Real Clear Markets. Good op-ed there. Don't want to miss that. All right. Number 2, let's adopt rules-based monetary policy. Monetary policy reform is urgently needed. The Fed's massive balance sheet expansion during the pandemic created market uncertainty and blurred its economic roles. Even President Trump has recently warned that without lower interest rates, the U.S. economy could stall, further highlighting the need for action. The Fed's dual mandate is maintain price stability and achieve maximum employment. But its most direct tools for achieving this are managing inflation by adjusting its balance sheet and the money supply. They really can't control that much of maximum employment, but it sounds good to Congress, so they put that in the law. But really, when you think about the Phillips curve and other things that Milton Friedman rejected decades ago, they really don't have control over real variables in the economy. But what they do is overinflate the economy, lead to asset bubbles and things of that nature, which we're continuing to deal with today. With a $6.7 trillion balance sheet fueling inflation, exacerbated by tariffs from the Trump administration and unchecked federal deficit spending by Congress, the Fed must prioritize reducing its balance sheet. Now, of course, that's going to be counter to what President Trump wants of lower interest rates, because you reduce the balance sheet, you contribute to higher interest rates. But I think that's what's needed given the inflationary pressures that are out there. President Trump has created his own problems with the tariffs and the trade wars and slower economic growth in the first quarter, which just came out as a negative 0.3%. And that's not just from imports, because remember, you subtract off imports in order to account for just domestic production. That's gross domestic output or gross domestic product, okay? And when you look at that, national domestic product in GDP, where you have the gross amount that's looking at nationally what's being produced and consumed and everything else, that wouldn't have to subtract out the imports, but GDP does, because those amounts are also included in consumption and investment by individuals and businesses. So you don't need to add them in there twice, or you have a double accounting problem. We should understand that. But what was concerning to me also about this is that we have a large increase in investment, which is good, but a big part of that was from changes in the inventories. Inventories that were built up during this unexpected or uncertainty that's going on with tariffs and trade. So a lot of businesses said, you know what, let me go ahead and invest today, get this, build up my inventory. And that may mean that we have less economic output in the second quarter because we won't see that same increase. I'm really concerned about a lot of these things. I don't know that we're in a recession yet or not, as I mentioned on the Joe Pag show and others. But I do think that we have slower economic growth than otherwise because of this ridiculous trade war and tariffs and everything else. So what can the Fed do? Well, at the end of the day, I would love to end the Fed. Let me put my cards out on the table. I think we should end the Fed as quickly as possible, move to more of a free banking sort of system where we allow markets to work and market rates to be set and allocate resources throughout the economy. But that's unlikely to happen soon. So instead, we need a rules-based framework, such as capping the Fed's balance sheet. It's not talked about as much. There's the McCollum rule, and there's some other things that talk about money supply. And even Milton Friedman talked about the money growth rule, which could be run by a computer, which would be a step in the right direction. But I would like for us to start looking more at the Fed's balance sheet. That is where they are controlling different assets throughout the economy with all these different programs that they have and putting money in mortgage-backed securities and agency debt and treasury securities. I mean, that is really where the manipulation happens and the distortion throughout the rest of the economy. So instead of just targeting interest rates, which can be helpful, and I think the Taylor rule is a good step in the right direction, I really would prefer us to look at the Fed's balance sheet. Now, as I mentioned earlier, in 2008, before the great financial crisis, the balance sheet was only about 6% of GDP. So relatively small. Maybe it was still too large at that time, but that's what it was then. Now, that's compared with the current 23% of GDP. So if we were able to get it back to that 6% and say that's a cap, and we'd like to be less than that, what we would have then is this would dramatically improve transparency and help rebuild market confidence while allowing for markets to work to set interest rates throughout the economy and therefore allocate resources more efficiently and effectively than what when the Fed is doing. But it would also put more pressure on Congress and the White House to start acting on reducing spending, which is the main problem that we have going on right now. So we're in a pivotal moment. The Fed must reduce its balance sheet. Congress must rein in deficit spending and limit the Fed's emergency powers. And a full audit should be conducted to ensure accountability of the Fed. The White House can play a vital role by urging fiscal discipline and getting rid of its trade wars. Together, these reforms would curb malinvestment and pave the way for more profound structural changes, ultimately leading to ending the Fed. I've got a lot more of this in my recent podcast as well that you don't want to miss. So go ahead and check that out in the show notes at vanceginn.substack.com. All right, let's go to the next one. Number 3, foster fintech innovation. Fintech has the potential to, and this is financial technology, what they have going on out there, has the potential to expand access to financial services, lower costs, and drive innovation. But regulatory uncertainty, particularly around the blockchain and digital assets, is holding it back. One major concern is the CFPB's Section 1033 rule, which requires financial institutions to share consumer data with third parties, including fintech firms, when authorized by the consumer. So instead, we need more competition. Section 1033 poses a threat to consumer financial security and imposes substantial compliance burdens, particularly on smaller financial institutions. Larger bank and fintech firms can absorb these costs more easily, creating an uneven playing field that reduces competition and ultimately harms the very consumers the rule claims to protect. A smarter approach to data sharing is that consumers should have the right to share their data, but access to bank infrastructure should be voluntary and market-driven. Fintech firms should negotiate and pay for access like any other business in a free economy. That's how real innovation happens, investment is rewarded, and consumers are protected. They should also have, Congress should also adopt a light touch regulatory approach, focusing on fraud prevention and rather than obstructing innovation, removing barriers to peer-to-peer lending, digital payments, and crowdfunding will empower consumers, increase competition, and unlock new economic opportunities. Check out my latest piece on Section 1033 in the show notes, all right? Number 4, privatize housing finance. More than a decade after the 2008 financial crisis, Fannie Mae and Freddie Mac, these government-sponsored enterprises, remain under government conservatorship, sustaining a system of implicit taxpayer guarantees that encourage risky lending. And in fact, they become explicit over time. Meanwhile, lawmakers across the country are pushing misguided efforts to penalize institutional investors for housing, falsely blaming them for rising housing costs and declining home ownership, despite evidence to the contrary. Imagine that. But instead, we should privatize Fannie Mae and Freddie Mac. It's just essential to reduce taxpayer risk and restore accountability in the housing market. It would encourage sound lending practices and allow market forces, not government guarantees, to guide home financing. We should also reevaluate the federal housing programs, whether it's the Federal Housing Administration or others, because what they do is they promote over-leveraged home ownership and they create instability within the housing market, when we really should have the market forces and prices from supply and demand driving the market, not unsustainable government intervention. And we've also got to stop scapegoating investors, guys. Professional investors aren't the problem. They helped expand and maintain a supply of quality rental housing, especially during the pandemic and the shutdowns. Demonizing them distracts from the real issues: excessive regulation, outdated zoning laws, and high property taxes. If lawmakers truly want to lower housing costs, they should start by addressing these issues instead. I have this in one of my recent pieces that's in the show notes that you don't want to miss, that called The War on Institutional Investors in Housing. Number 5, allow competition to thrive. Government bailouts and market interference must end. Propping up failing institutions creates a moral hazard, encouraging excessive risk-taking without accountability. Now, lawmakers are also targeting interchange fees, pushing bills to ban banks and credit cards unions from collecting fees on the tax and tip portions of credit and debit transactions, further distorting the market. All right. Price controls like these have proven record of failure each and every time. They distort incentives, limit supply, and ultimately harm the consumers they claim to help. Real competition requires government to step aside, giving consumer access to the products and services that meet their needs and letting businesses innovate freely. Consumers don't need protection from choice. They need access, transparency, and freedom to make their best decisions given the resources that they have. We also should protect the payment ecosystem. Interchange fees are crucial to a secure and functional payment system. I don't want to pay fees just like you don't want to pay fees, but there's also a cost of doing business. Nothing is free. They help fund fraud protection, sustain payment infrastructure, and enable rewards programs. State attempts to carve out fee exemptions and federal proposals like a 10% cap on credit card interest rates may sound helpful, and they do in general, but they would undermine credit access and payment system integrity. This is a market sabotage disguised as consumer protection. And we've got to end the too big to fail, guys. With a national debt exceeding $36 trillion, taxpayer-funded bailouts must stop. Congress should implement clear market-based bankruptcy procedures to ensure no institution is quote-unquote too big to fail. This will protect taxpayers, strengthen accountability, and support long-term financial stability. Read my recent analysis of proposed interchange fee legislation in states like Texas, Louisiana, Alaska, and Florida. Hopefully all these will die. I've also got a piece called Killing Credit Access with Price Controls on Interchange Fees and Interest Rates. That's going to be in the show notes as well. You can also find my friends at the Competitive Value Institute shared excellent actionable strategies for achieving these goals in their report, Free to Prosper, a pro-growth agenda for the 119th Congress. I hope you'll check that one out. Thank you for joining me in this episode of This Week's Economy on the banking sector. I'm going to have more of these industry types of discussions. So please send me in the comments, any of the platforms where you get these podcasts, so I can have an idea of which industry you want to hear about. And then maybe you'll have me to come speak at one of your events. That would be fantastic. Or do some research for you, or just talk to you. I'd love to do that. For more insights, visit vanceginn.com and even get a greater value with a paid subscription or complimentary subscription to my Substack newsletter at vanceginn.substack.com to join the more than 35,000 subscribers and followers that I have across different platforms. All right. Thank you for joining me today. And until next time, God bless you and let people prosper.